All right. Good evening, everyone, and welcome to today's session, Real Estate Investing in the Current State of the Economy. I am Yelfrey De Leon. I am one of the co-founders at Helios Enterprise Holding, and this evening I am here with my lovely partners, Jose Martinez, Katie Cepeda, Patricia Higgins, and a very special guest and business partner that's here with us, and we will present him later. That's Paul Montelongo. All right. Before we get started, I just want to go over a very quick disclaimer. First of all, I want to mention that this session is being recorded, and the content of this webinar is for informational purposes only. Potential investors should always conduct their own due diligence and should always seek guidance from reputable professionals that can help them to understand and assess the risk associated with any investment opportunity. All right. So today I want to start out with a very famous quote from one of the wealthiest entrepreneurs of all times, Andrew Carnegie. And the quote says that 90% of all millionaires became so through owning real estate. Let that sink in for 1 minute. During this webinar, we hope to help you understand why we think that this statement is so powerful and it makes so much sense. We will be exploring the world of real estate syndication and show you how it can offer a very unique opportunity to achieve passive income and long-term wealth creation. We'll also be covering some of the basics of real estate syndication, including how it works, the benefits of it, and all of the risk involved with it, as well as what to look for when you're evaluating a deal and want to make an investment opportunity. Our guest speaker and business partner, Paul Montelongo, will dive a little deeper into some of the benefits of investing in real estate. And he has also prepared an illustration for some examples. So, we'll definitely let us know if you have any questions. We will have a Q&A session at the end. But definitely, please feel free to put your questions in the chat as we will go through this presentation. By the way, there is a Q&A session somewhere in the chat. I know that the chat is disabled, but you can definitely ask your questions there. And talking about questions, before we get started, I just want to know what's the level of real estate experience that we have in the room so that we can get to know you a little better. So I'm gonna have one of my business partners, Katie, if you can help me out here. You should see a question pop up in your screen. All right, so here we have. And Katie, you can help me monitor this.
Okay.
So guys, if you can please answer the question on your screen, we would really appreciate it.
I'm gonna give it like 5 more seconds. Okay. All right, I'll share it.
All right, so seems like we have some answers still coming in. All right, so that's good. So we have some active investors and a lot of novice investors that are looking to learn and potentially invest in their first deal. All right, so that's great. Thank you guys for sharing. So now that we know a little bit about you, let me turn on the page. Now that we know a little bit about you, let me tell you a little bit about us and who we are. My business partners and I have formed Helios Enterprise Holding because we truly believe that real estate is the #1 way for you to build generational wealth. Prior to creating Helios Enterprise Holding, we all had some experience in real estate, but we decided to start this company, and there was a time in our lives where we would have never thought that owning a building was a possibility for us. In fact, after we all bought some of our first, call it residential homes, we all wanted to scale, and we even had like brainstorming sessions because we just didn't know how to do something like this, of this magnitude. So, we often asked a lot of questions, and, that's when we started to dive in a little deeper. But of course, multifamily real estate syndication was something that was out of reach for us because we didn't really understand, or it wasn't at the level of our awareness. And that's exactly what we want to bring with this company. Through this company, we want to bring opportunities to individuals like you, to individuals like myself, people who really want to get into real estate syndication or want to have an opportunity to build generational wealth and receive some passive income, but may not know how can something like this be possible for them. For me personally, the pandemic that started in 2020 was a turning point. Why? Because it presented both challenges and opportunities that ultimately led me to slowly transition into real estate syndication, or become from a finance professional to become a real estate entrepreneur. Prior to the pandemic, I had built a very impressive career in finance. However, just like millions of Americans, I was also let go. It was then that I really realized that, there is no such thing as a job security anymore, and that I really needed to find ways to generate passive income and become financially independent. And, the reason I'm saying this, I'm not here to tell you, hey, leave your current careers. I mean, think about it. We definitely need the lawyers, the doctors, the bankers, all of these people, all of these professionals, we need them. But, this is rather to educate you and help you achieve some of that financial freedom and that financial independence that we're talking about. So with that, I'm going to pass it over to my team so that they can quickly introduce themselves, and we'll dive into some content from there. So, but Katie, if you can please introduce yourself.
Hey, hello, everyone. My name is Katie. I am the acquisition specialist for the team. I work hand in hand with Yelfree sourcing deals, and I also work primarily on anything that has to do with the brand image.
Thank you, Katie. Patricia?
Good evening, everyone. My name is Patricia Higgins. I'm the co-founder and managing partner of Helios. I specialize in due diligence and legal specialist. So diving into understanding the business and what the elements that will translate into on the actual production of the properties and so forth.
Thank you. Jose?
Hey all, thanks for joining. My name is Jose. I'm also a managing partner and a co-founder. So I manage the digital marketing and the image of the firm as well. Along with Joffrey, I manage investors relationship, and we all have different hats, but we all work intertwined to help the firm get to where it needs to go. So I hope you enjoy this webinar.
Thank you, guys. That was great. All right. So as my team mentioned, we all wear different hats. By title, I'm the investor relations manager, a managing partner as well. And yeah, we all work collaboratively to make things happen. So thank you once again for joining. And before we get started, I just have one more question for you guys. So Katie, if you can help me out here. You should see a question pop up on your screen in just a few seconds. All right, so the question is, and let me also share my screen. What is a multifamily real estate syndication? Come on, guys, this is a given. If you've been watching all of our videos and you're here today, you should know this one. So let's see. All right, so let's give it 5 more seconds, Katie, and then we can go ahead. All right, can you share the screen?
Yeah.
All right, awesome. So it looks like a lot of you guys got this one correct, and that is correct. So multifamily real estate syndication is when a group of, sorry, let me just close this here. It's when a group of people pool their capital together to acquire a larger property than you would have otherwise been able to acquire by yourself. Now, why is this important and why am I talking about this today? Well, the answer is simple. in a real estate or a multifamily real estate syndication, you're really dividing the responsibilities, and you have the ability to scale at a bigger at a much faster rate. Now, the important thing here is, how does it work? So on this slide, I have put together a very, a quick 5-step process as to how multifamily real estate syndication works. So, and it first starts with acquiring the multifamily property. So what does that mean? For us, typically it would be acquiring a multifamily building of 50 plus units. So during this stage, the managing partners, us, right, we relied on the many connections that we built with commercial real estate brokers, lenders, property managers. It's a team of professionals. We analyze, underwrite multiple deals to find the very few selected deals that will actually work for us. This is a very difficult process, as you would imagine. And we have to conduct a lot of due diligence, a lot of market research to ensure that we select the right property that will actually help us achieve our target returns to our investors. The next step of the process here is performing value adds. And what does that mean? So once we have acquired the property, we force the appreciation. How do we force the appreciation? We come in and we make some value-added renovations and that will improve the interior and exterior of the property based on the business plan, of course. And, like, for example, we may add washer and dryers, some lighting fixtures, upgraded cabinets. If there's a lot of pets in the property, we'll maybe add a little dog park if we also have the space in the property for it. We'll add a grilling area and other things that will actually improve or increase the value of that property. Okay, so that's what we call forced appreciation. Now, the next step in the process would be to refinance. Not always, though. In some instances, depending on the business plan, we may need to refinance. And especially in a particular market when there are when there are so many changes in the interest rates, and when you have to make major improvements to the units, and there's a lot of vacancies when you initially acquire the property. The next step in the process here is to hold the hold period. So typically we hold, when we acquire a multifamily property, we'll hold it for a period of typically 5 to 7 years. So during this period, we're really collecting cash flow, making sure that the property is stable, and we're implementing the business plan. And then at the end, we sell the property. So at this stage, the property has gained enough value that the best use of the real estate investors at this point is to just dispose of the asset and return the investor's capital so that we can utilize it, for another project, and then just repeat and repeat again and again. So this is the process. Now, I just want to quickly talk a little bit about some of the benefits of investing in real estate syndication. And I'm sure that at this point, you've probably heard about some of this, if not all of them already. So the first one that I want to talk to you about is regarding passive income. As we all know, multifamily real estate investors benefit from having a steady stream of income or passive income through quarterly distributions, also, again, depending on the deal structure of the deal, right? The second one here is appreciation. For appreciation, as I mentioned before, there is one type of appreciation, which is forced appreciation, but people also, or investors also, benefit from natural appreciation, which is market appreciation. The third one here, and probably one of the most important for a lot of those who are, high income earners, is the tax benefit. So real estate will allow you to to do tax write-offs in the form of depreciation. Depreciation is a tax write-off that enables you to keep more of your hard-earned income and lowering your taxable income. The other one here is stability. So, real estate has proven time and time again to be a very stable investment, usually outperforming the stock market. So, this is very good. Especially, I understand that many people will always say, and it is very smart to diversify your portfolio, but especially in markets like the one we are now, you may not want to invest your money in the stock market, because the stock market, there's a lot of volatility, and you may not want, that's not the place where you want to keep your money at this time. The next one here is generational wealth, and perhaps one of the most important for me in particular, and again, it goes back to the quote that I mentioned earlier. So many people are able to just generate wealth through real estate investments. And so, this one is really important as well. In terms of the risk, it is definitely a lower risk, because even if there is a recession, even if there is a COVID-19 or you name it, whatever it is, people will still need a place to live. So the other thing that helps is that we will usually invest, well, most times, always will invest in states that are landlord friendly. So, this will also help as well. And then recession resistant, real estate has always been a hedge against inflation. Even during the peak of inflation, real estate assets have appreciated enough to outpace the rate of that inflation. So, I will leave it at that for now. And if you have any questions, feel free to write it in the chat. And for now, I will just put my contact information. So the first card here, the contact card, the hi, hello, just make sure that, when you are saving my contact information, or when you scan your camera on the screen, you go all the way down and go to where it says create contact, so that you can have my contact information imported to your phone. The second one here is my Calendly. If you need to set up a meeting with me, feel free to do so as well. And then here, I also have some of our social media accounts. All right, so with that, I'm gonna stop here, and I'm gonna take a look at the chat to see if we have any questions. I know that we received some questions prior to the meeting. So, Katie, or one of my business partners here, will help me go through that. Katie, do we have any questions so far? And by the way, we will not, I'm just stopping here temporarily. Paul will dive deeper into some of these things. And so we will have a Q&A session at the end. But in the meantime, I'll take 2 to 3 questions for now.
So one of the questions that we have from Aline Collado is, are there any tax benefits associated with syndication deals? I know that you touched briefly, but if we can explain a little more.
The question is, are there tax benefits associated with real estate syndication? There are a bunch of tax benefits associated with real estate syndication, and I will briefly answer your question. However, we will have more, Paul Montelongo will dive a little bit deeper into, what those are. But yes, like I mentioned, there is depreciation expense. It's a tax write-off that you are able to take as a benefit.
We have another question from Chris Nolan. What is the minimum investment amount?
Chris Nolan, that is a very good question, and it all depends on the business structure. But I will say that for most of the deals that we have, the minimum investment amount, and for most syndication structure, it would start at $75,000. We can talk about it offline if you have more specific questions regarding that.
Okay. Samuel Tavares, how is a safe form to create, I would say, how is a safe form to create a capital to start working at real estate?
I'm sorry, can you repeat the question?
Yes. Give me 1 second. So how is a safe form to create capital to start, I would say, to start investing in real estate? Like, what is a safe way to create capital to begin investing?
Okay. Yeah, that is a good question. I mean, I would say that you definitely have to, I would say, put money aside. You need to start putting money aside, from your job, from your regular, W-2 income. And there are many other ways also, which again, we'll dive into deeper a little later. But there are dozens of ways, and how you can invest in real estate syndication. There is self-directed IRAs, 401k. There's many other things. So again, we'll dive into a little deeper into some of these questions. So I will take one. Oh, sorry.
There's another question regarding taxes. Again, Paul is going to touch a little bit more in depth into this, but the question is from an attending that doesn't have a name per se. Can you provide an example or two on tax benefits doing real estate? Joffrey mentioned one. Another one that I can mention is cost segregation, and the bonus 1031 exchanges.
Yes. Again, we'll have Paul who will answer all of your questions on tax and tax benefits. So, at this point, I am going to stop right here. Just want to make sure that we have enough time for Paul and, the Q&A session at the end. Okay. All righty. So, Katie, if you can help me promote Paul to the panelist view.
Sure, give me 1 moment.
And while Katie does that, it is my pleasure to present Paul Montelongo and have him here with us tonight. Paul Montelongo is a lifelong entrepreneur and business coach. And in his 40 years of career, Paul has generated close to $100 million in revenue and has employed over 1,000 people. He has investments and dispositions in over 1,000 apartment units throughout various markets in the US. And he also works with investors and professionals to help them maximize their profits. And Paul has also made hundreds of professional speaking appearances at real estate conferences, both nationally and internationally, including this one. So thank you, Paul. I also got to say that, for me, it is a pleasure to introduce Paul and have the opportunity to introduce him to you. This man is unbelievable, and I'm very grateful to be working along with such an amazing human being and great mentor. So with that, please help me welcome Paul Montelongo as a panelist. I just want to make sure that is Paul on?
Yeah.
Oh, there he is. Okay.
Should be joining.
And I am going to stop sharing my screen as well.
I'm assuming that I can be heard right now.
Yes.
All right. Thank you, Yelfrey and the Helios team. I appreciate your invitation for me to come over here and present to your group. And if you're on the webinar right now, the call right now, I think you're in for a treat. I have been in real estate since I was a young man, 40 years now. I purchased my first real estate deal when I was 17 years old. And since 2014, I've been doing multi-unit properties. I'll explain that in a moment. Why that's important now is because we're in an entirely different zone. We're in an entirely different era as opposed to the past 5 years. I personally have been through 4 recessions. Now, I don't know that we can call this a recession right now. It matches some of the definition, and it doesn't match some of the definition. However, I can tell you this, that in every downturn, economic downturn, there's a mindset, and that mindset is up to you. Will you participate in the economic downturn, or will you take advantage of the economic downturn? The first one that I was in, I was a victim. I fell victim to it. I let the herd mentality tell me how to think and what to think about real estate and business and life in general. The other 2, I became a victor in it. And I can tell you in the 2008, 2009, 2010 debacle, I made more money during that period than I had ever made in my life collectively. I think that right now, if we are in some kind of a downturn or correction, I think that if you really have the right mindset, you can make more money now than you ever have in your life collectively. I intend to do that. I see it. It's happening already. Our business is exploding right now. So I'm going to share with you why I think it's important, why I think the economic situation is prime for us, and then really how you can take advantage of it. Here's my commitment to you. I'll stay on as long as you want. I'll stay on as long as you want. You can ask any question. You can ask as many questions. Put it in the chat. Put it in the question box. I will stay here until the last question is answered. There was a period in my life where I was learning. There was a period in my life where I was earning. And then this period of my life, I am returning. So those aren't my words, by the way. I borrowed those from another fellow. And so, but I really liked them because it really resonated with me and really fit with me. And so when groups like Helios invite me to speak and to speak to folks like you, I just love it because I want you all to be successful. This makes the pie bigger. So I do have some slides. I'll move into those right now. We'll see how that goes. And just keep asking your questions, and then I'll address them periodically. Three things first. Whoever asked the tax question, please remind me. Whoever asked the question about the different ways to get into the real estate, I'll answer that, but remind me. And then whoever asked the other question that was how to start, like where to start with your money, remind me, and I will make sure that I answer that question. All right, let's go right here. All right, this is our presentation. By the way, screenshot that. That is my email address. You can email me for questions or whatever you have. I'm happy to see how I can help you. All right, so let me back up. In 2013, I was sitting in my home in Las Vegas, and I had just sold out of 2 businesses. I really was sort of semi-retired, but someone called me and they invited me. They asked me a question. They said, would you like to invest in a marina? And my immediate answer was no, because I didn't want to. I didn't know anything about marinas. I didn't know anything about boats. I had never owned a boat. In fact, I'd still have never owned a boat on my own. But then I started looking at the property and I started looking at the financials, and I thought, okay, I will get involved, because what they were looking for was someone with business experience, someone that had a net worth, someone that had some cash, and someone that could help manage the property. And at that point in my life, I fit all of those parameters. So one day I woke up and I had 115 boats. And this is the aerial view of the property that I purchased in North Carolina on Lake Wiley, 115 boat slips. And if you look kind of up in the top up here, it's an RV park, and there were 23 RV spaces. So why do I tell you this? Number one, there was an opportunity there that I did not anticipate, but as I looked into it, the opportunity presented itself and it seemed interesting. But I had been flipping houses, and some of you here have probably been flipping houses. I had been flipping houses. I'd been buying a rent house here and there. I did a couple of little commercial projects, although I'd been in real estate all of my life, but they were single transactions. Find one, fix one, flip one, sell it, move on, find one, fix one, flip one, find one, and I just figured that there was a better way. I would look at apartments, and I would look at multi-story commercial buildings, and I would go like, that's amazing. How do these folks do this? But here's what really made sense to me. I wanted not just one check. I wanted multiple checks. And so when an opportunity was presented to me to buy a multi-unit property, 115 boat slips and 26 RV spaces, that was a multi-check property. Well, 5 days after I took ownership of this place, this happened. The largest snowstorm in 10 years in North Carolina came in and crashed 8 boat slips and 4 boats. And that was about $38,000 worth of damage. 5 days after I took ownership of this. But as things would have it, we ended up repairing it. And then I removed every one of those RV spaces and I built these. I built 38 tiny homes in those spaces, and every one of those became what? They became a check. They became a check in the mail, a multi-unit property. We became Airbnb Superhost. These are rented on a 2-night minimums. They were rented somewhere between $159 and $229 a night on the lake. And so then I had 115 boat slips and 38 of these tiny homes. That's 153 checks, 153 streams of revenue. And this is what I want you to think about in terms of multi-unit or multifamily properties. Every apartment door is a check. And when you have multiple streams of revenue and multiple checks, your exposure is lessened and your exposure is hedged. This was my only marina project. I finally sold out my piece in this project. The interesting thing about this is, in order to obtain this property, we had to raise $1.4 million, and I did not have a clue. I did not know how to raise $1.4 million. In all of my businesses prior to this, I'd never raised money for anything. I always funded my own businesses. But in order to take this property, we had to raise $1.4 million. As good fate would have it, I was introduced to a man who helped me raise this money, and in 9 days, he raised $1.4 million. And so we were able to acquire this property. From there, he taught me he and another gentleman who was our partner on this, taught me how to invest in multi-family properties. And so why multi-family or multi-unit? So anything multi-unit to me is what you're looking for. I will explain more later what I consider to be multi-unit, but remember, the principle here is multiple checks, multiple streams of revenue coming into your mailbox. I'll explain that further in a few minutes. So why multifamily? Why am I so bullish on multifamily? Well, first of all, let's ask you a question here. What is your multifamily score? I want you to give yourself a score of 1 to 10. And how well do you think you know the business model of apartment investing? Now, by that, I mean finding them, evaluating them, pricing them, where the money is in the project, market analysis, all of those things that you see there listed, financing, raising equity, marketing. Like if you took all of those and put them together and that was your multifamily business, how would you rate yourself on a scale of 1 to 10? Gelfrey, is there a way for us to find out what the group numbers are on that?
Yes, if you can please put it in the Q&A, and we'll just
we don't want to hang around. Yeah, we don't want to hang around too much on this, but give yourself a score of 1 to 10, and this will give you a gauge as to kind of where we are in this process. Here's something else I want you to know. Right now, the demand, the United States is extreme. The United States needs 4.3 million apartments by the year 2035. That takes into account that during the pandemic, there was a deficit of 600,000 apartment homes. So 4.3 million new apartment homes between now and 2035, that's just 12 years from now. That's just 12 years from now. What does that indicate to you? That indicates to you that, and to me, that the demand is great, the supply is low, and that means what? that means that rents are going to be high. Rents are going to increase. And so when there's a lot of demand and there's little supply, and you can get your hands on one of the supply and it become your investment property, then, and you can raise rents because the demand is there, then you have a profitable transaction. Let's take a look at that then. Why multifamily now? Here we are in March of 2023, and I believe that right now is the best time for multifamilies in the last, I would say at least the last 5 years and maybe the last 8 years. Why? And here are the reasons I'm going to give you. And you can Google this and you can look up the statistics and these will all be verified. But rent is strong. In many markets across the country, rent growth continues to escalate. Now, in some parts of the country that have been strong in the last few years, rent growth is kind of leveling out, like in Central Texas, in Arizona. It's still strong. It's just not as strong as it was, say, 2 and 3 years ago. But rent growth is still strong. One of the indicators that you'll look at when you're evaluating a market is what is the average percent of growth, rent growth per year projected to be in that marketplace. That comes as a result of jobs and population and industry diversity and all of those things that support a strong market. Apartments are on sale. Here's how you know. Well, first of all, I know the apartments are on sale because the last 3 apartment projects that I purchased in the last 3 months, they have all been appraised at between 9 and 11% under, excuse me, 9 and 11% over what I purchased them for. So right off the bat, there's a, let's average 10% upside in the appraisal versus the purchase. And I purchased these at about 10% below what they were being purchased last year. So that gives me already a 20% upside in the value of these apartments. But apartments are on sale because interest rates are high and the perception are higher, and the perception in the marketplace is that it's harder to afford apartments. So they are on sale. Now, is it a buyer's market yet? I don't think so. It was a seller's market up until about April or May of 2022. So almost a year ago, it was a completely 100% strong seller's market. Then over the last 8 to 9 months, it started to shift. I don't see it as a buyer's market, but I do see that there's a better balance now between the seller's market and a buyer's market. So apartments, apartment complexes, apartment properties are on sale. We are seeing more buyer-friendly terms. I have seen more owner finance propositions in the last 2 months than I've seen the previous 6 years. In other words, owners are willing to carry the note on their property so that they can sell them, and because they know that they can beat and they're competing with the higher interest rates for multifamily loans. The increasing affordability gap. Now, what the affordability gap is, that gap or that distance between what an apartment unit costs a tenant and what a home mortgage costs a mortgage buyer. So the average in the country is a little over $900. So if you're going to rent an apartment for $1,000, then you're going to pay a mortgage of $1,900. But the affordability gap continues to grow because mortgage rates for homes are continuing to increase. So anytime that gap starts to widen, more people, because they cannot afford a mortgage, they move into the apartment community. They move into the multifamily space. They rent an apartment. We are seeing also distressed deals. What do we mean by distressed deals? Well, what we mean is that over the last 2 to 3 years, many apartment investor groups purchase their apartment projects on floating debt or bridge loans or variable interest rate loans. And so now those interest rates are coming due, and they're having to buy the latest interest rates, or they're having to pay a cap, or they're having to pay for an extension. And so that puts stress on the deal that they projected to make a certain profit, now that profit is dwindling. It's not uncommon for many investor groups to not be receiving dividends right now because the dividends they would have received are going toward mortgage payments. So the distressed deals are going to continue to grow for about another 12 to 18 months until we see a real balancing out of the interest rates. Other reasons, another reason that multifamily is good right now is the broker relationships. So if you have good broker relationships, you get the first call. In the previous 2 to 3 years in our industry, brokers would literally, for lack of a better term, splash the market with an offering, and then they would gather in a bunch of offers, and then they would drive the prices up, and then they would have another call for offer, and then they would drive the prices up. Sometimes they would have 3 calls for offers to drive the prices up. That's not happening right now because the market tends to see, brokers tend to see that if they can sell a property and sell it quickly to a group that performs, now is the time to do it. All right. So I'll tell you what, let's see what questions you have and if they relate to what I have covered thus far. Do you need an LLC to participate in wholesaling? What software platforms? Okay, I'm going to answer that. I'm going to answer that later. Okay, just hang on to those. Okay. So what are you looking for when you're looking to buy an apartment property, when you're looking to buy an apartment complex? We're looking for what we call value add assets. And this simply means that the apartment complex, the asset it says, has something that you can do to force the appreciation, to add value, to increase the value to the property. And so we're looking for properties that are under poor management. How do we know they're under poor management? Well, sometimes just a drive-by is all you need. You can drive by the property and you can tell that it's neglected. You can tell that it's being neglected because maybe they don't have a website, or maybe they have poor marketing, or maybe if you tour the property, the insides of the property are a disaster. The biggest way that you can tell is under market rent rates. And this is the biggest value add that we see. If we can find an apartment complex that has the rent rolls or the rent rates that are under the average market rate, now we have something to work with. What do we look for? We're looking for optimally $75 to $150 per month per unit on average under market rent rates. And that's without doing any improvements that could potentially bring us a little bit more rent. So in 2 properties that I just bought over the last 3 months, we have raised rents almost 20 to 22% on these 2 properties without doing any improvements because the rents were so far undervalued. Now we had some people leave because they didn't want to pay, a 20% increase in their rent, but that's okay because the unit is still at market value. Other tenants would come in and rent. So your market rates, under market rates is a key indicator. Growth areas. We talked a minute ago about supply and demand. There are still areas of this country that are in huge demand and the supply is low. The South, the Southwest, the Southeast, the Carolinas, the Midwest, portions of the country and different pockets of the country in these areas, the demand is still very, very strong and the supply is low. So when you're doing your market analysis, you're looking for these kinds of areas. Any property that needs rehab is a good subject to look at to purchase. Now, for myself personally, I don't like to do a huge amount of rehab. I like a little bit of rehab. There's a strategy in our business called repositioning, where you actually do a very extensive renovation or a very extensive rehab project to take, say, a property that's a Class C and move it into a Class B or a Class D, but I never buy Class Ds. I don't even look at Class Ds. But so typically, let's just say we'll stick with that. We take a Class C and we move it into Class B, but is what we call a reposition. That's a huge renovation. But I like to put lipstick on the pig. So if there's some paint and there's some flooring and there's some countertops and there's some landscaping and there's some parking lot striping and some of those things that are easily managed and that don't cost a lot of money proportionally, that's the kind of rehab that you're looking for, something that dresses up the property, something that makes the property appealing to the marketplace. And then my favorite is old, tired, burnt out owners. So I'll give you an example of one property that I purchased in Corpus Christi, Texas. We bought it at the end of December in 2022. That owner had owned the property for 25 years. And he's not an old guy. I think he was early 50s or so, 20, maybe mid 50s. So, you know, age-wise, he's not old, but he was done. He was done. He was an on-site manager. In fact, when we visited the property, he would dress up as a maintenance person so that we couldn't identify him. And he was just done. Now, we went in and we negotiated with the gentleman for nearly a year. And then we were finally able to make a deal. And he got plenty of money for his work over the last 25 years. And we got an asset that needed a little bit of help, but that was in a prime location. So mom and pops, you can look for and you can buy a mom and pop, but anything over 50 units is typically going to be listed with a broker. So that's why your broker relationships are key and most important. When you are an owner operator, when you are in the multifamily business and you are the sponsor, you are the lead, you are the person that is in charge, that is getting the property, this is just a few of your responsibilities. And there's probably another slide full of that. What you'd be looking for is how to find properties, evaluate deals, develop broker relationships, make offers, that whole list right there. And that's just, as I say, that's just a partial list. Now, why is that important? Because we're going to talk about syndication, and syndication is ideally designed for a passive investor to park their funds and your investment while you do all the work for them. In other words, you're doing all the heavy lifting, you're doing the due diligence, you're doing the day-to-day operations, you're making the deal happen, and in exchange, they're parking their money in your investment for a return on their money, a return on their investment, and then you're doing the work to make sure that that property meets or exceeds its projections, and that the equity is driven and that the value is driven. So you can screenshot this, because if you're in the syndication business and you're offering an investment opportunity to a limited partner, to an LP investor, this is just a handful of things that they are investing in. Yes, they're investing in the property, but they are investing in all of these aspects of the business that you are taking care of. I'll just tell you this, that my view, I think Yelfrey in the beginning, he kind of mentioned my bio a little bit there. And I've had numerous companies. I've had 9 companies. And well, now that I'm in the apartment business, I have many more. But I see each one of these apartment complexes as a business. So yes, I'm buying an apartment complex. Yes, I'm buying a property. But more importantly, I believe that I'm buying a business. I'm buying the business. I'm buying the name. I'm buying the customers, the tenants. Oftentimes I'm buying the personnel, even though I'll replace them. I'm buying the marketing. I'm buying the good debt. I'm buying the bad debt. I'm buying the evictions. I'm buying the vendors. I'm buying the landscapers. You see, you understand? I'm buying everything there is about the business. I am buying a business with the objective of making that business my own. So when I buy an apartment complex, I'm buying a business. And so in terms of operating the business, these are just a few of the things that we do to operate a business. And these are just a few of the things that your limited partner investor is investing in for you to own and operate the business on their behalf. So let's see if we have any questions here that I'm going to answer all questions, as I promised. What are the different classes? Okay, we'll go to that one. What kind of cap rates do you see across residential? Okay, we'll answer those two. Okay, and I'm not ignoring the others. I'm just gonna. This kind of falls in line. Okay, you have 4 classes. Let's see who answered that. Luis Tejera. Okay, Senor Lewis, you have 4 classes: A, B, C, D, and A's your best, D's your worst. A, brand new or very new product, lots of amenities, pool, gym, business center. Let's see, sometimes like a beach on the pool, covered parking. You know a Class A project when you see it. Now there's a Class A plus, and those are really, really high-end properties. But your Class A typically is what I just mentioned. Class B is just below that. A little bit older, maybe built in the 80s or 90s, usually a garden style, 2-story, usually has a pool, usually is fenced or gated, may have a business center or may have a clubhouse, but just a little bit older product. And it's in a B area. In other words, the demographic is a B and the income is a B. C, just below that, maybe a few less amenities, maybe a little older product, and maybe smaller units, maybe needs a little bit more repairs, and maybe in a little bit less quality of a neighborhood or less income on the demographic. So you got A, B, C, and D. D, you know a D when you have to carry your gun into the neighborhood. So I don't do Ds. Okay, I don't do Ds. I don't buy Ds. I just don't. You have a negligent tenant base. You have low income. You have low median income. You do not have pride of ownership in the product, in the property. So we just don't buy that. Typically, Luis, we will buy a C plus to a B average or a B plus. So anywhere between a C plus and a B plus are all the properties that I have right now. I do have one Class A property, very nice property, but typically everything else is that C plus to a B. And I think right now in 2023 and moving forward in the next 12 to 18 months, those are the properties to buy. Think about it. If there is economic pressure and there is a lower jobs growth, and if there is lower income, then people who are living in A's, they move down to B's or C pluses. People that are moving into B's, living in B's, they move to a C plus. People that can't find a home at a reasonable mortgage rate, they're going to live in a B. So your C plus and your B's, those are your properties to be looking for at this moment. I hope that is helpful on the different classes, Luis. The other one was, what kind of cap rates do you see across residential multifamily properties? How do these vary by classes? B, C, D. Yeah. So when we do market evaluation, we take a look at the cap rate. That is the capitalization rate. That is the rate that the market feels the property value is. And we take a, each market is independent of a different market. So Houston's different from Dallas, is different from Phoenix, is different from Kansas City, is different from Miami. Each one has its own independent cap rate. We evaluate the property, we evaluate recent sales to determine the cap rate. Most of the country in the classes that we're buying, we are seeing about 5.5. 5 to 5.5. Now this is really good because this time a year and a half ago, those same properties were 4.5 to 5. So when you're a buyer, you want a higher cap rate. When you're a seller, you want a lower cap rate. So as a buyer, we like to see a cap rate that's right along lines of the interest rate. So the last 3 properties that I bought, the interest rate was 5.33, 5.37, and 5.67. These were all bought in the last 60 days. Excuse me, 90 days. So interest rate, those are the interest rates, and all the cap rates on those were about 5.5 to 6. So we like to see a correlation between cap rate and between interest rate. Doesn't have to be that way, but that's a good rule of thumb. So 5.5-ish or so. I hope that answers your question. Ds, we don't buy Ds. Your class A's, they might have a lower cap rate because you have less risk in those properties. So we'll pay a little bit more for those properties because there's less risk. The tenant base is better, less improvements or no improvements, rehabs. So we'll pay a little bit lower cap rate. Okay, hope that answers your question. Oh, wow, lots more.
Lots of
Let's see.
questions. Keep them coming. So I want to address one of the questions here from Ottavio Caproni. Can you please go over the exit strategy? Paul, maybe I'll let you answer that component of the question. What's the average holding period, and are you involved in all of Helios deals? So, the average holding period will depend on the business structure, typically, 5 years. And is Paul involved in all of the deals that Helios has? So currently the deals that we are raising capital for, which some of you may know of already, yes, Paul is involved in those deals. Typically we partner with experienced operators like Paul Montelongo. Paul is one of those experienced operators we'll partner up with, but there are others as well. The deals that we currently have on the table are Paul is directly involved with. Paul, if you can go over the exit strategy.
Yeah,
exit.
Yeah, sure. It's a great question at a perfect time. Exit strategy. Okay, so we bought a property. Now what? So we always develop a business plan before we buy the property. And that business plan is a 3 to 5 year business plan. In other words, we plan on exiting or disposing of or selling that property in 3 to 5 years. Now, because of where we are in 2023 and the uncertainty and the interest rates, so forth, we may have to hold that property 5 or 6 years, but that's okay. So my personal track record is a disposition in 33 and a half months. Let's call it 34 months. So a little less than 3 years. So what we do, Ottavio, is we develop the business plan. We say, all right, we're going to stabilize the property. That means we're going to raise rents. We're going to get our tenant base nice and steady. We're going to have, we're going to be steady on the property. And then about year 3 to 3.5, we put it out to market and we say, okay, does the market have an appetite for this property? We've already raised value. We've increased the tenant base. We've improved the tenant base. We did our improvements. Does the market have an appetite? If the market has an appetite and it makes sense to sell it and it makes sense to our investors to exit, we pull the trigger. If it doesn't make sense, we hold on to it for another year because the business plan, remember, is 3 to 5 years. In some cases, it's been a while. It's been a long while. In some cases, we might hold it 6 or 7 years, but the typical exit strategy is 3 to 5. All right. What's the best advice you can use on an ELOC? Let's see. Okay. Well, I mean, your ELOC is a line of credit. So if you wanted to pull out money out on your home as a line of credit and use it to purchase properties, I suppose you could do that. I've never done it. I kind of like, I don't like to do that. And I like to keep the equity in my home. But you could do that. That's the purpose, the line of credit. Okay. I would rather see you use a self-directed IRA, or I would rather see you use what I call lazy cash that maybe is laying around in a CD or some kind of money market product that's only earning 2 to 3%. I'd rather see you use that on an investment property. Okay, hope that answers it. Let's see. What percent of your investment goes to the fees tied? Oops, what happened here? What percent of your investment goes to the fees tied to the syndication deals or operating expenses? Goes to the fees tied. Well, typically you're going to have 2 to 3% acquisition fee. In other words, as an owner operator, as the person who puts together the deal, as the syndicator, you're going to ask for a 2 to 3% fee of the purchase price to put together the deal on behalf of your investors. There are other fees. You have a 2% asset management fees. Sometimes you'll have a 1% disposition fee. In other words, you charge a percent of the sales price to exit the property. It's a lot of work to exit a property, a lot of physical, time intensive type work. So that's a justifiable expense. Okay, your operating expenses. What we like to see is when we underwrite under operating expenses, at least a 50% expense ratio. But that's when we're underwriting it. But when we operate it, we like to move it to about a 42 to 45% expense ratio on the property. In other words, 42 to 45% of our money is going toward expenses. But we'll take a serious look at a deal if the current expenses are 50%, or we think that easily we can get it to 50%. All right, hope that answered the question. Let's go back up to the top. Do you need an LLC to participate in wholesaling?
Sorry,
I'm not a law.
Can you see
What's
that?
that?
Yeah,
I
no,
can
go.
see it. It says,
Okay.
do you need an LLC to participate in wholesaling? I'm not a lawyer. I don't play one on TV, and I've never played one on TV. But every real estate transaction that I do personally, I have been advised to put it in its own LLC. So every transaction that I do, even when I wholesale, I operate my properties through LLCs. The question is, do you need one? I guess that would be up to you. Do you need one? I can tell you what I do, every single one. By the way, when you buy an apartment project, it has its own LLC, and your investors are investing in the LLC. They're not putting money into your account. They're not putting money into your personal LLC account. They're putting their investment into the LLC that holds and purchases the property, the apartment complex that you're buying. Okay. Here's another question. What software platforms or groups have you leveraged to build a network of investors, realtors, mortgage lenders, etc.? You ready for this? LinkedIn, Facebook, Instagram, LinkedIn.
There's a number of them. I mean,
So now those are the marketing software, marketing platforms that we use. Like, we just put our message out there. Now, once we actually operate the business, there's all kinds of software platforms to manage the portfolio, to manage your investors' investments, to hold their documents. There's Appfolio. There's all kinds. But if I gather what you're talking about, we do all of our promotional efforts through your main social media outlets. Okay. And by the way, if you're brand new and you've never done this, those outlets, those social media outlets, are a good place to find brokers, to find partners, to find realtors, to find other investors, to find general partners, to find sponsors. And you just start striking up conversations with them, follow them, like their posts, comment on their posts, ask questions, engage with them. That's the best way. All right.
I would just add to that, it's important to keep a CRM or customer relationship management tool
You bet.
to ensure that you keep all your contacts organized, phone numbers, emails, etc.
Okay. That's perfect.
Also, a question on another note, which I think is really important for novice investors. So it's from an anonymous attendee, and they asking, how fast do you start seeing a return on an investment like this?
So we anticipate, or we expect and project that a return on investment or quarterly dividend comes about 6 to 9 months after acquisition. So typically the first dividend happens within the first year of ownership, and then every quarter thereafter. Why? Because we want to get in, we clean house, we do some rehab, We implement our own software, our own property management. We make the business ours, and then it begins to cash flow in such a manner that we can pay investors somewhere around month 6 to 9 at the first disposition, at the first distribution. Okay. What's the average ROA on those operations? What's the average Okay, so in this business, we have 3 measures of success: the IRR, internal rate of return. That's the value of the business in a percentage wise with all of its operations internally, including mortgage. And that numbers, we like to see it between 15 and 17%. The other crucial number is cash on cash return. That's the interest, or that's the dividend that is paid on a person's investment over a yearly basis. At this time, we like to see that between 5 and 7% on average annually. The other crucial indicator is what we call annual rate of return. And that's the average annual rate of return. So once we sell the property and then we back in the profits, we like to see an annual average return of about 20%. So a typical investment, you'd be getting 6%. I'm just going to use round numbers. You'd be getting about 6% a year on your money. And then once we sell, because of the profits, we back in the profits, and that raises your 6% to an average of about 20%. Those are projections. Those are our group, my company, we always evaluate very conservatively so that we can pleasantly surprise ourselves and our investors. But that's about the average. Right now, in the economy that we're in, if investors can get a 6 or 7% rate of return each year, cash on cash, that's really quite good, because the stock market and other forms of investments are not performing that well right now. So that is another reason why apartment complexes are good at this point. Okay.
There are a number of questions. I don't even know where to go next. But I think one that's really important here is, are there any penalties for investors that would like to sell their position before the sale of the property?
Well, there's not a penalty. Well, it's not a penalty per se, but there are expenses that go against profits that you may have earned if you exit your position early. And by the way, our position is our company position is, if a investor wants to exit early for a legitimate reason, they're sick, they have a family issue, for some other reason other than they just woke up on the wrong side of the bed, then we will usually work with them very easily. We'll buy their position, or we'll pass their position on to another investor that has been on the waiting list. So we have options, but it's not penalties, but there are, what's the word I'm looking for? There are expenses, that go against that. Okay. Aline asked, thanks, Paul. One more question. What do you wish you would have known when you were just starting out in real estate, your career? The thing that I would have learned, or thing that I would have really focused on, was raising capital. As our businesses continue to expand and we've added more doors, there continues to be more of a need for capital. And, in the beginning and up till lately, we use the capital and investments of our friends and family. And so now we are expanding our network to include other investors so that we can buy more deals and we can acquire more doors, because we have the business model down. So if you're just starting out, Somebody else said something here. Yeah, if you're starting from zero. Listen, if you're starting from zero, or if you want to know what you can do to make an impact in this business, is learn and master capital raising, because you will become very valuable in this space to owner operators. I'm what they call a syndicator, an owner operator. I'm the key principal. So I guarantee the loan. It's my net worth. It's my experience. It's my liquidity that guarantees the loan. And having said all that, I still have to be in the capital raising business so that we can fund these deals that we are buying. So master capital raising. I hope that helps. All right. Is that all the questions we have at this moment? Did I
There
answer?
are more, but we can continue and then we'll come back.
All
There's
right.
a question of, I mean, I don't know, you still answering questions, Paul?
Yeah, sure.
Yeah.
Sure.
So there's a question from an attendee that it's logging in from New Zealand overseas. And they asked it when they registered, and they asked how you can invest if you're investing from overseas, if there's any ways to do that.
Yes. So that's the foreign investor status. I'm not clear on all the exact steps, but a foreign investor can invest in the United States. There's some clearance there. You want to talk to an SEC, Securities Exchange Commission attorney. Typically what we'll do is we'll take only American investments. So what foreign investors have done, and I do have foreign investors in my deals, but they have parked their money in an American entity and an American LLC that is managed by someone who's an American. So that American LLC now invests in our property. So that's the way, you know, that's the big picture of how to do that. Okay. All right. So
Just
let's
one
talk
more.
about. Yeah.
Sorry,
go
I'm
ahead.
just
Go
gonna
ahead.
address one more question here that was asked earlier. I can't see it anymore because there's many questions here, but somebody asked if we can go over the differences between a 506B and a 506C deal. And I think this
Sure.
one is particularly important, especially for those people that may not meet the accreditation of an accredited investor. Paul, I'll
Sure.
let you answer that.
Sure. So in the syndication model, all right, we have two ways to do this. We're making an offering, and the first way is through what we call an instrument called a 506B offering. So you can remember 506B. That's your brothers. 506 brothers. That's your friends and family. That's people with whom you have a pre-existing substantive relationship. So in other words, as an example, Yelfrey and I, we've known each other for quite a while now. We've done business, we've talked, he's seen my deals, I've seen his deals. We have a substantive relationship. Therefore, he would qualify as a 506B investor. That 506B investor can be an accredited investor, or the offering can contain up to 35 non-accredited investors. What is an accredited investor? An accredited investor meets one of these criteria. They have $1 million net worth, excluding their personal residence. They earned $200,000 in each of the last 2 years, and the projections are that they will continue to earn $200,000 a year. Or the person and that person's spouse together earned $300,000 as a household for the last 2 years, and their projection is that they will earn $300,000 for the upcoming years. And then along with that, you know, they have to have some knowledge, some experience with some know-how about real estate. A non-accredited investor, you know, is a person that just has money. Maybe they don't have $1 million worth of assets, but they just have money for however they got it. The second class is what we call a 506C. And I remember that this way, 506 community. So you are able to market or present or pitch that transaction out to the community at large. Social media, people that you don't know, people that are friends of your friends of your friends, and all of those individuals must be accredited investors, and they must show a letter or some form of proof that they are an accredited investor. That proof usually comes from their attorney, their CPA, their financial advisor, a letter, or a third party vendor that we can use to verify their accreditation. And so those are the two classes. We like to see from the start, we like to see a property as a 506B with our family and friends, with our brothers. And then if that raise is not complete, then we can move it over into marketing it in a 506C. You can go from a B to a C. You can't go from a C to a B, because once it's out on the world, you can't pull it back. Is that clear? All right. Another question, and then I'll get into how to get into a deal. Any other questions?
Yeah, so, or maybe we do have this prepared, but can you provide some examples, an example or two of tax benefits doing real estate?
Yeah, hang on to that question, okay? That's a big topic. Hang on to that question.
Okay.
I promise you I'll answer that question. I promise you. I double promise you I'll answer that question. Oh, what the heck? I triple promise you I'll answer that question. All right. So how do you get into one of these deals? Let's say you're a person that has no money, no experience. You're a person that has a huge desire. Well, there's that category. Then, or let's say you're a person that has some experience and you have some money. There are multiple ways to get into a multifamily property. So your first way, obviously, is just to go buy it, to pay for it. This is the dumbest way to do it. Do not do an all cash purchase on a $10 million property. Dumb. Because if you have $10 million worth of cash, first of all, you'll know that what I'm telling you, that's a dumb idea. If you have $10 million. Why is that dumb? Because you can leverage that $10 million into 3 or 4 or 5 different properties and multiply your holdings and multiply your potential returns and multiply exponentially your net worth by using that by breaking up that $10 million and using it. So all cash purchase, not a good idea, but it is a way. I put it in there. Next, you can become a credit partner. So let's just use the example here of these 4 individuals here on our screen from the Helios group. And let's just say that we want to get into a $10 million deal. And I'm looking for the deal, okay? But Jose's the one that's got really good credit. So I can say, Jose, you have great credit. Come on over and be a partner, and you can help me get the loan because of your credit. He says, okay. But then Yelfrey has some cash. And Yelfrey has some cash and good credit. All right. Yelfrey can come on to the sponsorship team and help get that loan. But now let's say that Katie has good credit. She's got some cash. Oh, she's got some experience. Now that's brilliant because she becomes that partner. Now let's just say that Patricia has a network that is crazy good. And Patricia has a network that has money. So now she becomes the syndicating partner. And this is brilliant because Patricia doesn't necessarily have to bring her own money if she can bring the money of 10 or 15 or 20 other investors. She becomes a part of the transaction, a co-sponsor as a syndicator. She does have to perform according to the SEC guidelines, but Patricia knows that, right, Patricia? All right. The other way is just a passive investor. So you're not a sponsor, you're not a part of the general partnership team, but you know, you've got an IRA account, or you've put away a couple of $100,000 and you'd like to come into an investment as a passive investor. This is a very wise way to get into a deal because someone else is doing the work for your money while your money is at work. This is ideal for people who are doctors and who are chiropractors and who are lawyers and who are CPAs and who are business people. And I'm dealing with a group right now, they're automobile dealers, okay? So they're in the business of selling automobiles and not in the business of doing real estate, but they have money. Okay, they can park their investment money into real estate. Very wise. Another way is if you have an IRA and you want to self-direct the IRA. So the rules of IRAs and retirement accounts allow you to self-direct or to move money out of your IRA into a real estate investment, and that real estate investment then pays your IRA. So that's called a self-directed IRA. Now, let's just say you have no money, no experience, no network, no IRA, no credit. You're just hungry. Well, you're what I call a hustler. So, but you can find deals, and you're very valuable to somebody like me who's always looking for a deal. And so you're what we call a deal locator. And as a deal locator, there are numerous ways for you to get paid. You can get paid by being a partner in the deal. You can get paid a finder's fee. There's numbers of ways to get paid, right? Wholesaling is not an uncommon thing in the multifamily business. If you have some kind of management skill. Now, do you remember in the beginning when I told you that I got involved with the marina? So yes, I had some business experience, and yes, I had good credit, and I had some cash and so forth. But the biggest thing that I brought to the table for the lender, they wanted an experienced business person. So I had management experience. I had hired probably over 800 or 900 people to work for me. Since then, I've hired over 1,000 people. So I had management skills, and I actually had construction experience. So that was a very practical, useful skill there. Now, if you do all of those, if you can combine all of those, all into one big bucket, I call you the GOAT, the greatest of all time. All right, here's the syndication model. The syndication model works many ways, but typically, on average, you have a 70-30 split. So 70% of the entire deal goes to the limited partners or the passive investors. Passive investor has no managerial responsibilities. They are not responsible for the day-to-day operations. They are not responsible for anything in the transaction other than placing their investment in the LLC to make the deal happen. The 30%, the remaining 30% goes to the general partnership team. That general partnership team is responsible for the day-to-day operations, for the asset management, for the property management, for the disposition of the property, for the financials, for executing the business plan. And that is the typical syndication model right there. You will see sometimes an 80-20, sometimes you'll see a 75-25, sometimes you'll even see a 60-40. But this is the majority of the ways that you will see the syndication model split up, right? Let's do this before we go to that thing. Do we have any more questions, like up-to-date questions? Because this next piece is going to be like, I'm going to tie it all together.
Yeah, so some questions are currently being answered. We still have 4 questions, and some are still coming in.
You want to do questions? Or you want to move on?
We can move on.
Let's move on. Here we go. All right. Now, this next part is like I'm going to give you an example of how a deal actually works. So for the purposes of I want you to wrap your head around this. For the purposes of this example, we're going to talk about a deal that's 100 units, property that's 100 units, and we're going to pay $100,000 a door, $100,000 a unit. Therefore, we're going to pay $10 million for that property. And the rents are currently $1,000 per unit. Does it make sense so far? $10 million, 100 units, $1,000 per unit. That means that, then we're going to increase the rents 3% a year. So let's go back. So we say that a unit is renting for $1,000 per unit per month. If we increase the rent 3% per year, that means that at year 5, that unit will be renting for $1,160 a month. Why do we say 3%? We say 3% because on average, that is how we calculate in our business model the increase of rents on a year-to-year basis. Remember, this is an example. When you do your market research and your market analysis, the market will tell you what you can raise rents. This is a very conservative number, 3%. In 2 markets that we're in right now, the rent average are raising 6 to 7% a year. But this is 3% a year. At year 5, that 1 unit will be worth $1,160 per month. If you take that 1,100, that should be 1,160 a month. That number should be 1,100. Whoops. If you take 1,160 a month times 12 months times 100 units, that gives you $192,000 additional cash flow. You with me on that? Now, if you take that $192,000, you remember we had the conversation about the cap rate. Remember we said that the average cap rate in the market right now is around 5.5. So if you take the $192,000 of additional revenue and you multiply it times a 5% cap rate, you get an additional $3.490 million in increase just by raising the rent 3% per year. So your $10 million property is now worth 35% more than what you purchased it at. That's just from increasing rents. That does not include if you charge for pets, or if you charge for covered parking, or if you charge for trash, or if you raise the rent 5% instead of 3%, or if you charge other kinds of fees. Yes, there are expenses that go against this, but for the simplicity of the example, just that 3% raise in value in rent gives you another $3.5 million in value. Does that make sense? So that's the dynamics of apartment investing. And remember, you're getting cash flow all along the way. So here it is, $10 million. Oh, you know what? That number is correct, $160. So that's $160 a month right there, more than your original $1,000 a month. That is correct right there. $160 a month times 12 is $192,000. Oops, $192,000. $3.4 million. You can take a screenshot of that if you want to, anybody. What questions do you have about this part right here? Because I don't want to leave anybody confused on this part. Are there any questions, Yelfrey, on this part?
Nope, not right now. Seems to be.
Okay. All right, great. So how do we apply this? All right, I'm going to give you some examples. This property right here, we bought in December of 2020. We sold it in March of 2022, 18 months later, actually 16 months later, 64 units, Class C plus. And we paid $5,065,000. We sold it for $7.475 million in 16 months. Class C, 64 units, 3 buildings, right there in San Antonio, Texas. We then 1031 exchanged into a Class A in Wichita, Kansas, 70 units, built in 2016, $8.950 million purchase. Recently, well, 5 months after we bought this one, in Wichita, Kansas. We bought this one in Corpus Christi, Texas, 142 units. This is a Class C plus, a very large property, well, it was $11.6 million, and it's already appraised at 13.3. We also bought this one here in Wichita, Kansas for $6,019,000. It is appraised for $6.5 million. And we are buying this one this month in San Antonio. It is $18 million, and we have an appraisal on the table right now from the lender for $19.3 million. So you can see these properties. This is a Class B or Class C plus, B minus property. And so, you know, this is the kind of properties that we're looking for. We just made an offer on this property last week. This property, we offered $42 million on it, and we're waiting on a response from the broker. This is a Class A property, and you can see why. Pools, metal roofs, multi-stories. So you remember in the beginning, I talked to you about multi-unit properties and multiple streams of revenue. So I see this applying in other facets. So we have recently purchased some land, and we are building storage on it, mini storage, self-storage. So this dark area here is the self-storage, and this up here is a convenience store. This is the rendering. This is the convenience store right here, but all of this is the self-storage that we're buying, that we're building. And why are we doing that? Because it is multiple checks. So the business model, the syndication business model can apply, it will apply, it does apply to self-storage. So since we know the syndication business model so well, and we have an investor database, we went ahead and are buying this property and putting this self-storage on. Any questions?
Great. Thank you, Paul. Let's see. Let's look at the questions here. So
if you're on the Zoom, don't go anywhere. I have a gift for you.
so we still have, and by the way, we also forgot to mention there's one more property that we put on an offer on, and currently waiting for the broker to let us know the good news. So thank you for that. All right, so we still have 3 remaining questions from before, and that is the tax question, the tax benefits question.
Okay.
Yeah.
Let's do tax benefits. Here we go. Tax benefits. All right. So if you are an active investor like me, it's your full-time job, you get full tax benefits. You get like bonus depreciation from cost segregation. And so what that means is we do a cost segregation analysis. In other words, there's a company that goes in and puts a value on all the components of your property, and then they depreciate those components over a certain time frame. And whatever that depreciable amount is, that is your depreciation, your bonus depreciation, and you get it up front. So if you're a passive investor, then you get the regular depreciation. It accumulates in a bucket until we sell the property, and then you get to apply the depreciation to the profits on the property. Every year you receive a form called a K-1. That's the real estate version of your W-2 or your 1099. It tells you how much you made in profits on the property, and how much the depreciable amount is, and then you square that up with your tax professional. Now, why is this important? Because if you're in the real estate business full time and you're earning a profit, you don't want to pay taxes, and so the depreciation amount is the hedge against your tax liability. And the name of the game really is to carry over a loss from year to year to year to year to year. And so I've been able to do that the last 5 years. And the way to do that is, to get into the real estate game. There is a thing called active investor and real estate professional and passive investor. So there are some parameters that qualify you as a real estate professional or as an active investor. Typically, you have to be in the real estate business 750 hours a year, but there are ways to do that. If I would say this, if you have money and you need a hedge against, I'm going to make this offer to you, okay? If you have money and you need a hedge against your tax liability, please reach out, tell me that, and I will put you in contact with what I consider to be one of the best tax consultants in the country. He's not a CPA, but he is a tax consultant. He helps people reduce their tax liability through real estate and other vehicles. We actually are working together. He's an investor in one of my properties, and we came to know each other, and his strategies are excellent. And so I don't mind referring you to him. And just like, if that is important to you, send me an email. And then I will put you in contact with him. Okay. By the way, that email is paul@montelongocapital.com. All right.
Paul, sorry, go ahead.
Yep. Go ahead.
So before we continue, I know that we are at time. So, please feel free to stick around so we can answer your questions if you do have some questions. I see that the questions keep coming in, so that's great. For those of you that, you have to leave because you have other prior commitments, please feel free. I see that somebody asked here for my contact information. Again, I will share my screen in a minute. So feel free to grab that. And, again, feel free to stick around if you have other questions.
Yeah, let me do this. Let me make the offer to the group, and then I'll just leave it on the screen, and then we can continue to answer questions. Okay. So I published an ebook. It's a free ebook, Earn a Lifetime of Profits and Passive Income with Little Cash Credit. So this is how to earn. This is how to get into the multifamily apartment investing business in a variety of ways. It's a short ebook. You put your name, email, address in it, and I'll send it to you. It's free. And there is that's the barcode or QR code. So I'm gonna leave that up right now. That's the free ebook investing guide that I will send people. So I'm gonna leave that up, and we can continue to answer questions. You got a question for me?
Let's see. All right. So what is the minimum buy-in for this type of project? We answered that, but we can go over that again.
It's $1 million. I just saw that movie lately. Right? Typically, it's $75,000 to $100,000. Each investment is different, but $75,000 to $100,000.
Come talk to one of us if you have questions regarding that. We can talk about it.
Sure.
All right, so let's see. Regarding funding, is it necessary to have partners when investing into multifamily properties?
No, it's not. If you can do all those things that I showed you on that slide, you can do it all to yourself and raise the capital and guarantee the loan and run the property and sell the property. More power to you. Or if you can manage the people yourself that can do all of that, more power to you. I have just found that to scale, you have to collaborate. And so to grow, you have to collaborate. And so having partners was, I'll tell you, having partners was not a thing I was familiar with until I got into this business. All of my businesses prior to this, I was the sole owner, the sole executive. And so, but coming into this, you're playing a bigger game. You have more, you have a bigger entry ticket. And so it's typically requires partners. I know personally some of the biggest apartment operators in the country, and they have partners. They team up so that they can continue to get bigger. This is a team sport. As I mentioned. Absolutely. You can't do it all by yourself. I mean, you can, all power to you. But yeah.
All right, so one very important question here, and honestly, I do not know the answer, but Paul, you can help us out here. Are syndications ever done with retail, industrial, etc., asset class?
So actually, the syndication model goes through a lot of different industries. I've seen it apply in the legal industry. I've seen it apply in the wine business and vineyards. I've seen it apply in horse racing. I've seen it apply in real estate. Those just come off the top of my head. So if you're thinking of buying an industrial park or an industrial building or industrial complex or a large commercial tower or building or retail space or storage or mobile home park or multifamily or RV park or any, or even like cell phone towers, 5G towers, all of those you can use the syndication model. In other words, you're gathering a group of investors together, their money, and you're going out and making the deal happen. Obviously, you want all the paperwork to document that, but the syndication model applies to many different industries. Yeah.
Great. We have one more question here. What do you think about funds versus syndication?
Funds versus syndication? Is that what the question is? Funds?
Yeah, so I think they mean like creating a fund, a pool of funds, as opposed to like a particular class it or offering.
I like it. I like the idea of a fund. I like it a lot. We feel like that's probably that's our next frontier, is to create a fund. Here are the advantages to a fund, in my opinion, and that's why I'm thinking so hard about it. If you're raising money into a fund, you have the ability to go out and get a deal immediately. So in order to get a deal, you have what we call pursuit costs. So your pursuit costs are the legal cost up front, the inspection cost up front, the lender fees up front, the earnest money deposit up front, all of those monies that you must put up before you actually acquire the property. Those are called pursuit costs. And so if you have a fund that allows you to use the money from the fund in pursuing deals, then that gives you the ability to pull the trigger on a deal much quicker than, hey, Yelfrey, I think I'm about to do a deal. Let's go find a bunch of friends so we can find the the $500,000 earnest money deposit. You see the difference there? So I like the idea of a fund. From what I know about the funds, they have to be very specific, they're very outlined, they're detailed. The parameters of the fund are laid out in advance, and you have to stay within the parameters of the fund. You want an SEC attorney to arrange the fund. Fund creation, I'm told, is an attorney fee is somewhere between $30,000 and $70,000. I know that's a wide range. I think it depends a lot about on how much money you plan on putting into the fund or raising for the fund. But I like the idea.
We have one more question here. Are there any government programs or incentives available for first-time home buyers or low-income individuals? That's a good question. There are tons. So you want to go ahead.
Yeah, there are. That's a little bit out of the realm of what we're talking about here, but I'm sure that if you did a Google search, you could find plenty of those.
Yeah. Yeah, I mean, I would say, just to elaborate a little bit more on that, if you mean on a single family home, you can buy with an FHA loan. It's different than what we're presenting here, but I can definitely take that one offline with you. Do you like affordable housing?
I don't have an opinion about affordable housing. I'm not in the residential space. I mean, other than I flipped 3 houses last year. That's only because I can't, it's easy to flip houses, right? I flip about 3 or 4 houses a year just because, but I'm really not into the single family residence space. I'm in the multifamily, multi-unit space. So not an expert.
Great. Well, I think that's it for now, unless anybody else has any last minute questions. Oh, we do have one more. Oh, no, never mind. Do you like apartment buildings with affordable housing programs like Section 8? The same person asked.
Well, that's a good question. The interesting thing about Section 8 is that it's dependable revenue. And I will tell you that I have had a property with Section 8 tenants, and the income was dependable. The income was actually a bit higher than market rent, which was interesting. And if the tenants didn't behave, they run the risk of their Section 8 funding being removed from them. So they typically were pretty decent tenants, quiet tenants. So I'm not opposed to it. Now, having said that, there is a stigma that goes along with it. So you want to make sure that it doesn't affect the overall environment of your property. In addition, when you get an agency loan like Freddie Mac or Fannie Mae, they will typically only allow you a certain percentage of your property to be Section 8 or government housing or government funded housing or participation for your tenants. They typically, well, it varies. It could be 5% to 15% of the property of the tenants. So, if you have a property that has a lot of Section 8, the upside is, or the pro is, that it's a dependable source of income. The negative side or the con side is the stigma and your ability to get that property financed or refinanced.
I love that the questions keep coming. Wow. You guys are very engaged. All right. So we have a couple more questions here now. So what should I consider when looking for a property that may need repairs or renovations? And I'm gonna, do you mean, when doing a fix and flip? I don't wait.
Let's see. You want to take me off there? And let's see. Just put us. Let's just hold on a second. Hold on a second. Let me do.
Yeah. Hold on. Yes, when doing a fix and flip. So the question is, what should I consider when looking for a property that may need repairs or renovations for a fix and flip?
For a fix and flip?
Yeah.
I mean, it doesn't say fix and flip. What should I consider?
Oh, no. But then when I asked the question live, they said yes.
They say yes for a fix and flip.
Okay, for a fix and flip.
Yeah.
The key thing that you want to look for in a fix and flip is what we call the ARV, after repair value. In other words, once you fix that property up, what's it going to be worth and what can you sell it for? Is it comparable to others? Okay. So then you take your purchase price, you add your potential repairs, and then how much profit do you want to make on that? So let's just say you buy a property for $100,000 and you put $50,000 of repairs in it. So will you take $200,000 for it? Or do you want 225 or do you want 250? And then that 250 or that 225 needs to be compared to the market. That's your after repair value. So the answer is the amount of repairs that you do are relevant only to the amount of money that you want to make on the property. And that's determined by the after repair value.
Great. Let's see. Hold on. I got lost here. So Per Lamar, there are other regulations involving and the management. You have to comply with government rules and regulations. And then you also have some other comments here. Perla Mar, can I make you, excuse me, can I allow you to talk? Can you help me out here? Kate?
Oh, listen, this question here, anonymous attendee says, do you have investments in tenant-friendly states? Can I answer that one?
Sure.
Only only landlord-friendly states. Only landlord-friendly states. So you want properties in states that it's easy to evict tenants when they don't pay. You want properties in states that do not have controlled rent. You want properties in states that favor the landlord rather than the tenant. Now, you be a fair landlord, but you want them favorable to the landlord.
100%. Right.
Do I support Airbnb rentals? Heck yeah. You bet. Especially if you had 4 of them spaced around the country in cities that you would like to live in each season. So if you have a property that you'd like to live in the fall, then you rent it out the other 3 seasons.
I love that. You know, just to comment a little bit on that, I actually started in real estate by doing Airbnb actually. So my first property, it's a nice apartment overseas. I actually took out some money from my 401k at the time. And I purchased a nice luxury apartment in Panama, and I turned it into an Airbnb business. You know, next thing you knew, I was saving for a multifamily property in New Jersey, and so on and so forth. So I love Airbnb. I mean, I think it's a very good business model. And you know, short rentals, it's hot on the market right now. So definitely.
So you remember earlier we were talking about the tax status and the depreciation and that sort of thing. And I made the offer to talk to the tax professional that I know. So one of the things that I learned from him is that if you are not a professional real estate, if you do not have professional real estate status, that owning and operating an Airbnb could quite possibly put you in that professional real estate status. So, you know, if you own an Airbnb or a couple of Airbnbs, then I think it would be good if you talk to this tax professional, buddy of mine, or if you're thinking of becoming a real estate professional, excuse me, if you're thinking of becoming a real estate professional, then I think you should talk to my buddy and let him give you some better direction. Because Airbnbs, I mean, that business model is here to stay for a long time.
Agreed. I just want to mention here, somebody asked, will the recording of this webinar be available after the call ends? And I see Katie is responding to that question. Yes, so this webinar is being recorded, and we can certainly send the link to it. Just give us some time, as we'll have to deal with the technology behind it. All right.
Jorge says, what are some ways to negotiate with sellers to get a better deal on a property? It's a great question, actually, really good question. Because anytime you can talk to the seller, you have a better opportunity of landing a deal. Listen, the real estate business, there's a lot of numbers, and there's bricks and mortar and wood and bricks and more bricks and lumber and, you know, a lot of things. But at the end of the day, the real estate business is more of a relationship business than anything. And so your relationships with brokers, your relationships with your business partners, your relationships with lenders, your relationship with sellers is key. So if you can get to have a conversation with the seller by simply asking the broker. You can ask the broker to allow you to have a conversation with the seller. I always like that. That's an ideal thing. I would say probably 8 out of 10 times the answer is yes, I get to talk to the seller. Maybe more than that. And so when I talk to the seller, I just try to find out about the seller person, the seller. How'd you get the property? What have you done with the property? What else do you do? Why did you buy the property? What do you plan to do with the money after you sell the property to me? Do you have other properties for your family? Do you have legacy properties? You know, those kinds of things. What do you like to do in the world? Where have you been? How's your family? So these kinds of questions and these kinds of rapport building conversations help you get a better negotiating point with the seller. Every seller has leverage. Every seller has a big reason why they are selling the property. And if you can get to that reason and work to that reason, then you have a better chance of selling, or excuse me, of the seller saying yes to the transaction and you being able to buy that property. Think about this, every sales, every sell is, it revolves around a story. It revolves around your story. It revolves around their story. Yes, there's some details and there's some mechanics, but there's a story. There's a human story. And if you can get to that and build rapport with a seller, you got a really good chance of the seller saying yes to your property, to the deal on your property. Does that answer your question successfully, Jorge? That's my belief, and that's my experience, by the way. You're welcome,
Oh,
sir.
sorry, I was on mute. Okay, so it seems like we have answered those questions for now. I just want to mention that I see some people scheduling calls on my calendar. If you want to know more, if you have more questions, if you want to know how to get into these deals, if you want to get into a deal, definitely schedule a call with us. Let us know. We'll schedule a 30 minutes discovery session, see what types of deals you're looking for, and how can our team help you. Both our team, Paul, both can help you, achieve those financial needs. And so, yeah, we'll take it from there. So definitely let us know and keep engaged.
Okay. Yeah, great.
At this point, we do not have any other questions. So let's, maybe we'll wait 1 more minute. And if there are no questions, then we will end this webinar. So let's see. It's your chance to do last minute questions, guys. Oh, actually, we do have more questions. This was very informative. Thanks, Paul. Thank you, Darlene. Okay, so when you first started, did you use mail campaigns or any other direct to seller methods to source your deals? That's a very good question.
Anonymous, or is that Mr.
Anonymous,
or
yeah.
Ms.? I'm just kidding. Every transaction or every deal that I've ever done has been through a broker relationship. I've not used mail outs. I've not used any other, call centers or any of that. I've never used anything but just picking up the phone and calling realtors, calling brokers, finding out what they have, finding out what they need. And I will tell you this, if you see that a property is closed and you can find the broker on that property that closed that property, you can pick up the phone and you can say, congratulations, broker. And by the way, I'm in the multifamily space. I want to know if you've got something else. So there are a zillion ways to build relationships with brokers. And listen, you can't, in my experience, you cannot pick up the phone tomorrow, call a broker and go, what deal do you have? And he's going to send you a deal and you'll do a deal. It takes multiple conversations with brokers. Develop a relationship. And if you're not a relationship person, wrap yourself with somebody that is, and or develop your skills. And that it's just, I cannot overemphasize that. My wife and I, we are members of multiple investment groups and meetup groups and masterminds and real estate groups, strictly for the networking, strictly to be able to be in relationship with people that are in our industry and in our business and think and act the same way that we do at a higher level, so that we can attract cool people and good deals. So it's relationships.
I can agree with this more. You know, definitely brokers relations, they're very important, and they will actually influence. I mean, even though the brokers is not the one who picks your offer, they will influence, you know, who or what
They
offer
sure will.
the seller will take. So that's very important. I see a number of participants here have been saying thank you. Thank you, Paul. Great information. Looking forward to the next webinar. Thank you for joining. It's a
I
pleasure.
see one more question there. One more question from Jorge says, can you recommend any creative financing options that may be available to someone with limited funds? You bet. So seller finance right now is an option on the table that was not there in the last 2 to 3 years, because it didn't need to be there, because lending and borrowing money was so inexpensive. But now that borrowing money is more expensive, seller financing. So if you can get a seller to finance or to carry some of the you know, the paper on his property, that's a good thing. And by the way, if you can find somebody that will owner finance, I will go in and I will get the difference. I'll find the difference. Helios and us will find the difference. Okay. But if you can get a seller to commit to seller financing, because that is a very good strategy for creative financing.
Perla Mod mentioned she's a great friend and also operator and syndicator. So she mentioned the person that asked a question about affordable housing, that she would like to provide her email to answer those questions. So I don't know if I can type it here, but I will say it really quick. It's P Vega, so it's PVEGA at GEFA capitalinvestments.com. P Vega PVEGA GEFA capitalinvestments.com. Feel free to ask her that question.
Yeah, and we can also follow up offline to ensure that they have received this. Okay. Any other questions? Going once, going twice.
So
Nope. All right. So I think that's the end of it.
all right.
Let's see.
Thank you very much. Appreciate the opportunity, and I enjoyed it, and I hope that everybody here got good value from it.
Great. Thank you all for joining up. There's a question from Jorge. Jorge, I will follow up with you offline. Are there upcoming or potential developments that may affect the value of the properties? Very good questions. Where are you taking these questions from?
What does he mean by that? Are there coming or potential developments that affect the value of the property? Well, I'll give you this answer. Let me give you an example. So I told you we bought a property in Corpus Christi. We purchased it and we closed on December 28th, 2022. 1 week later.
Hey, Yelfrey, you want to do a sound check? Can I hear you?
I can hear you.
Perfect.
Hello, Helios. Can I have Jose, Katie? Right. Just bear with me 1 second.